Hello everyone, and welcome to your daily market briefing. Today is Monday, November 17th, 2025, and we are kicking off a week that could define the rest of the year. Over the last 24 hours, the market has been gripped by three massive stories. First, the AI bubble is showing serious cracks. We saw a vicious tech sell-off late last week, and now, a nervous market is rotating out of its biggest winners. Second, the great data blackout in the US is finally over. After a record-long government shutdown, we are about to be hit by a deluge of economic data that will finally tell us if the Fed will cut rates in December or if that hope is completely dead. And third, the crypto market has just imploded. Over the weekend, Bitcoin officially erased all of its gains for the entire year, plunging to levels that have shocked the bulls. We're going to break down all of it. The indices, the macro, the political comments, and that crypto crash. Let's get right into the numbers. Let's start with a snapshot of where we stand this Monday morning. Right now, US futures are trying to find their footing after a rough end to last week. But this small green arrow comes after a very telling session on Friday. On Friday, the Dow Jones closed down 0.7%, finishing at 47,147. The S&P 500 was mostly flat, down just 0.1% to close at 6,734. But the Nasdaq actually finished up 0.1%, which masks the real story. The real story is the brutal rotation under the surface. For the week, the Dow was actually up, while the Nasdaq booked its second losing week in a row. Money is flowing out of tech and into more defensive sectors. This anxiety spread across the globe overnight. In Asia, markets were mostly lower. Japan's Nikkei 225 fell 0.3% after some very weak economic data. We'll get to that in a minute. Hong Kong's Hang Seng dropped about 1%, and the Shanghai Composite was down 0.4% amid its own disappointing data. The one bright spot was South Korea's Kospi, which jumped 1.7% on some local tech news. In Europe, markets are opening subdued to lower. The Pan-European stocks 600 and the German DAX are both starting the day in the red. This follows a sharp sell-off on Friday, where the UK's FTSE 100 lost over 1.1%. So, the global picture is one of caution. Investors are spooked, and the big question is, why? It comes down to two things, the AI hype and the Fed. The main theme driving Wall Street right now is the sudden and sharp questioning of the AI bubble. For months, the market has been carried higher by a handful of mega-cap tech stocks, all riding the artificial intelligence wave. But on Thursday and Friday, that trade came to a screeching halt. We saw a violent sell-off in major AI names, and investors are now openly debating if the sector is dangerously overvalued. We're seeing capital flee from high-valuation tech and pile into defensive sectors like healthcare. This is a classic risk-off rotation. This brings us to the single most important event of the week. Forget the macro data for a second. All eyes, and I mean all eyes, are on Nvidia. Nvidia is set to report its earnings on Wednesday. In the analyst community, this isn't just an earnings report. It's being called an industry-wide truth serum. Nvidia is the poster child for the AI boom. Their results will either reignite the entire tech rally, proving the hype is real, or, if they disappoint on guidance, it could trigger an acceleration of this tech sell-off. The stakes could not be higher. If Nvidia stumbles, the whole market stumbles with it. Now, for the second biggest story, the macroeconomy. For 43 days, the market has been flying blind. The record-long US government shutdown meant that for over a month, we have received no official economic data, no inflation reports, no jobs numbers, no housing data, nothing. That ends this week. We are about to be hit with a data deluge. This week, we are finally getting the delayed releases for the Empire State Manufacturing Index, industrial production, housing starts, jobless claims, and crucially, the FOMC minutes from the Fed's last meeting. This data is everything because it will finally give the Federal Reserve the information it needs to decide on its next move. And that brings us to the real pain point for the market. Hopes for a December interest rate cut are collapsing. Just 1 month ago, the market was pricing in a 95% chance of a rate cut in December. As of this morning, that probability has plummeted to less than 50%. Why the change? Because even without the official data, Fed officials are sounding very nervous about inflation.
Over the last 24 to 48 hours, we've heard from several key Fed presidents. Minneapolis Fed President Neil Kashkari said he is still undecided on a December vote.
He flagged the resilience in the economy and his ongoing concerns about inflation. Cleveland Fed President Beth Hammack was even more direct. She said that while she's worried about the labor market, getting inflation back down to the 2% target is critical. The message is clear. The Fed is not convinced its inflation fight is over. They would rather keep rates high and risk a bit of a slowdown than cut too early and let inflation reignite. This higher for longer reality is what's spooking the market. Higher rates are bad for high-growth tech stocks. They're bad for the housing market. And as we're about to see, they are absolutely toxic for cryptocurrency. The US isn't the only place with problems. Let's do a quick roundup of the other macro and political events from the last 24 hours. 1. Japan's economy shrinks. This morning, Japan released its Q3 GDP data, and it was not good. The Japanese economy contracted at a 1.8% annualized pace. This was worse than expected and marks the first economic drop since the first quarter of 2024, all thanks to very weak private consumption. In response, we're hearing rumors that the Japanese government is preparing a massive 17 trillion yen stimulus package to try and prop up the economy. 2. China's data disappoints. Data out of China on Friday was also weak, with factory output and retail sales both hitting 14-month lows. This continues to weigh on the entire Asian-Pacific region. 3. Geopolitical tensions. Japan versus China. In the political sphere, tensions are rising between China and Japan. China is escalating its objections to comments made by Japan's Prime Minister, Sanai Takaichi, who suggested a potential Japanese military response if China were to make a move on Taiwan. Analysts are now calling this a consequential macro input, meaning it's a new political risk that markets have to price in. 4. UK budget U-turn. In the UK, there was chaos in the markets on Friday after reports surfaced that the new Chancellor, Rachel Reeves, is set to ditch plans to raise income tax at the upcoming budget. This U-turn sent London stocks tumbling and weakened the British pound, which is down again this morning, trading around 1.3150. 5. Oil and gold. Finally, in commodities, WTI crude oil is down about 1%, trading at $59.39 a barrel. This is partly because operations have resumed at a key Russian port on the Black Sea that was previously halted by a Ukrainian strike. And gold is also slipping, down 0.4% to $4,066 an ounce. This is a direct result of those fading Fed rate cut hopes. When rates stay high, the US dollar gets stronger and gold becomes less attractive. All right, now for the story that has the crypto world in a panic. Over the weekend, Bitcoin officially wiped out all of its gains for the year 2025. The price plunged, briefly crashing below $93,714. After a tiny rebound this morning, it's struggling to hold the $95,000 level. Let me be clear, this is a full-blown bear trend. The exuberance is gone. So what happened? First, the Fed. Just like with tech stocks, crypto was flying high on the hope of Fed rate cuts. With that hope now evaporating, Bitcoin and other risk assets are being dumped. Second, the Trump exuberance is fading. The Trump administration has been seen as pro-crypto, which helped fuel the rally earlier this year. But a friendly political stance is not enough to fight the gravity of Federal Reserve monetary policy. Third, and most importantly, the big buyers are gone. We're getting reports that the major players, the ETF allocators, and the corporate treasuries have quietly stepped back from the market. They are no longer buying. In fact, we saw $870 million yanked by ETF investors in the recent downer. There is no better symbol of this than Michael Saylor's MicroStrategy. For years, that stock has traded at a massive premium to its actual Bitcoin holdings. As of this weekend, that premium is gone. The stock is trading at parity with its crypto stash, signaling that investors are no longer willing to pay extra for Saylor's leveraged Bitcoin model. And it's not just Bitcoin. The pain is worse in altcoins. Ether is down, though it's holding up slightly better, trying to reclaim $3,170. but a broad index of smaller alt tokens is down around 60% this year. This is a complete liquidation of the crypto space, all driven by the new higher for longer rate reality. So, let's tie this all together. We are entering one of the most pivotal weeks of the year. 1. The market is nervous. The AI-fueled rally is on thin ice, and investors are rotating to safety. The entire tech sector is holding its breath for one single earnings report from Nvidia on Wednesday. 2. The data blackout is over. This week, we will finally get the real numbers on the U.S. economy, which will confirm or deny the market's new fear that the Federal Reserve is not cutting rates in December. 3. The crypto winter is back. Bitcoin has erased a full year of gains as big money buyers head for the exits, proving that crypto is still just another risk asset at the mercy of the Fed. This is a week to be cautious. The volatility is back. We will be tracking all of it, especially that Nvidia number. That's all for today. Thank you for watching. Make sure to subscribe for our daily updates, and I'll see you tomorrow morning.